Have you ever felt a knot in your stomach as the market plunges, a desperate urge to sell everything, or perhaps the intoxicating rush of a stock soaring compelling you to buy more regardless of the price? These are not just feelings, they are hidden taxes on your investment returns. Emotional trading, driven by fear and greed, erodes profits more subtly than any commission or management fee. In the calm light of day, we analyze balance sheets, dissect economic reports, and construct elaborate spreadsheets. But when the market storms rage, those carefully laid plans often crumble. Rational analysis gives way to panic selling or euphoric buying, actions divorced from logic and grounded in primal instinct. This is the battlefield where the critical investor must learn to fight. Today, we'll uncover the hidden risks that emotional trading poses to your portfolio. These aren't abstract concepts, they are common pitfalls capable of tripping up even seasoned investors. We'll explore how these biases manifest and, more importantly, how to inoculate yourself against their influence. Consider the wisdom of Warren Buffett. Be fearful when others are greedy and greedy when others are fearful. It's a simple statement, yet profoundly difficult to execute. It demands a contrarian mindset, a willingness to stand apart from the herd, and above all, unwavering emotional discipline. Because in the relentless pursuit of wealth, your greatest asset isn't always a hot stock or a sophisticated algorithm. Often, it's the cold, hard steel of a rational mind. Are you ready to master your emotions? And in doing so, master the market? Let's dive into our first hidden risk, the endowment effect. This is the sneaky tendency to overvalue things simply because we own them. It's like a comfortable old armchair. Objectively, it might be worn and outdated, but we cling to it because it's ours asterisk. In investing, this translates to an irrational attachment to underperforming assets. How many times have you held onto a losing stock far too long, hoping it will rebound, even when your rational analysis screams sell? It's the endowment effect whispering in your ear, clouding your judgment. Averaging down, buying more of a losing stock is often touted as a savvy move, but beware, you may be throwing good money after bad, fueled by emotional attachment rather than sound logic. You're not investing, you're rationalizing. So, how do we break free from this trap? Implement a predefined stop-loss strategy. Before you buy any asset, determine the point at which you will sell based on objective criteria, not emotional whims. A trailing stop-loss can protect profits and limit downside risk, automatically adjusting as the stock price rises. The endowment effect is like clinging to a sinking ship. Your emotional attachment won't change the ship's fate. Sometimes, the smartest move is to abandon it and swim to safety, reallocating your capital to more promising opportunities. Are you willing to let go of your sinking ships? Our next hidden risk is the herding instinct. This is the powerful, often subconscious, drive to conform, to follow the crowd. It's what makes us laugh at jokes that aren't that funny, and, more dangerously, what compels us to invest in assets that are wildly overvalued. Think back to the dot-com bubble of the late 1990s, fueled by widespread enthusiasm and the fear of missing out. Valuations soared to absurd levels. Common sense was abandoned in the rush to get rich quick. But as we know, the bubble burst, leaving many investors with devastating losses. The painful truth is that the crowd is often wrong, especially at market extremes. Blindly following the herd can lead you straight off a cliff. So, how do we resist this powerful urge? Cultivate a contrarian mindset. Conduct your own independent research and analysis. Be willing to go against the grain when the data supports it. Use valuation metrics like the price-to-earnings ratio or price-to-book ratio to identify overvalued assets, even if everyone else is clamoring to buy them. The herding instinct is like lemmings rushing towards the sea. Independent thought is your life raft. Will you blindly follow the crowd, or will you chart your own course, guided by reason and analysis? The choice and the consequences are yours. Our third hidden risk is confirmation bias. This is the tendency to seek out and interpret information that confirms our pre-existing beliefs, while conveniently ignoring anything that contradicts them. It's like building a fortress around your opinions, only letting in the voices that agree with you. In the financial world, this manifests as only reading news sources that align with your bullish or bearish outlook. If you're convinced a stock is going to soar, you'll only read articles that support that view, creating a distorted picture of reality. The danger is that you believe you are well informed, when in fact you're trapped in an echo chamber, reinforcing flawed investment decisions. This false sense of security can be devastating. So, how do we escape this trap? Actively seek out dissenting opinions and alternative viewpoints. Use tools that show how different media outlets frame the same news story. Debate your investment ideas with someone who holds opposing views. Force yourself to confront information that challenges your assumptions. Confirmation bias is like wearing blinders. You only see what's directly in front of you, missing potential dangers and opportunities on the periphery. Are you willing to remove your blinders and see the market with clear, unbiased eyes? It might be uncomfortable, but it's essential for making sound investment decisions. Our final hidden risk is loss aversion. This is the powerful psychological phenomenon where the pain of a loss is felt far more strongly than the pleasure of an equivalent gain. It's why we often cling to what we have, even when better opportunities beckon. This can manifest as an action, holding onto cash during a bull market, paralyzed by the fear of a potential correction and missing out on significant gains. You're so afraid of losing a little that you end up losing a lot. While prudent risk management is essential, excessive fear of losses can be just as detrimental to long-term wealth accumulation. You need to understand that calculated risks are necessary for achieving superior returns. So, how do we overcome this paralysis? Reframe your thinking about risk. Use strategies like diversification and position sizing to manage risk effectively. And always consider the expected value of each investment decision, the potential reward weighed against the potential loss. As Warren Buffett might say, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Don't let the fear of losing a few drops prevent you from catching a fortune. Are you ready to overcome your loss aversion and seize the opportunities that await? So, how do we build a fortress against these hidden emotional risks? How do we become truly rational investors? It starts with establishing a clear, written investment plan. This plan should outline your specific goals, your risk tolerance, and your asset allocation guidelines. It serves as a roadmap to guide your decisions during periods of emotional stress. Next, implement a checklist of objective criteria for evaluating investment opportunities. Include financial ratios, competitive analysis, and macroeconomic factors. Minimize the influence of subjective feelings and biases. Regularly review your portfolio's performance against your investment plan. Identify any deviations and rebalance as needed. This ensures that your portfolio remains aligned with your long-term goals, even when your emotions are pulling you in different directions. Finally, practice mindfulness and emotional awareness. Recognize the signs of emotional biases creeping into your decision-making process. Take a break from the market when feeling overwhelmed or stressed. Sometimes, the best investment decision is no decision at all. Building a rational investor framework is like constructing a fortress against the storms of emotional trading. Discipline and structure are your strongest defenses. Are you ready to build your fortress and become the master of your financial destiny? We've journeyed through the treacherous landscape of emotional trading, uncovering the hidden risks that can sabotage even the most well-laid investment plans. The endowment effect, the herding instinct, confirmation bias, and loss aversion. We've also explored the path to mastery, building a rational investor framework, a fortress of discipline and structure to protect us from the storms of emotional impulses. Remember, emotional control isn't about eliminating emotions altogether. It's about understanding them, acknowledging their power, and managing them effectively. It's about recognizing when your feelings are clouding your judgment and taking steps to regain clarity. Benjamin Graham, the father of value investing, wisely observed, the investor's chief problem, and even his worst enemy, is likely to be himself. The greatest battles we face in the market are often internal, struggles against our own biases and irrational tendencies. So, take proactive steps to improve your emotional intelligence. Delve deeper into the fascinating world of behavioral finance and decision-making. Read the works of Kahneman, Tversky, and Toller. Continuously challenge your assumptions and seek out diverse perspectives. The path to mastery is a lifelong journey, a continuous process of learning, adapting, and refining your approach. But with awareness, discipline, and a commitment to rationality, you can transform yourself from a reactive, emotion-driven trader into a proactive, intelligent investor. Are you ready to embrace emotional intelligence and unlock your full potential in the market? The power to control your financial destiny lies within you.